everyone. Thank you for your attendance today. And so I'll point out that I've changed the title on the slide here. The email invitation was benefits of an IC disc. I've changed this to read federal tax export incentives. And that's because I want to also talk about an additional export incentive that came about with the new tax legislation in 2018. So the bulk of the conversation today will still be on the IC disc, but the new incentive is foreign derived intangible income. We want to talk about that a little bit as well. So I'm Mark Griswold, and with me today is my colleague, Chris Stroh. We are both managers with Bailey's International Tax Department, and we will be presenting the topics to you today. So we'll start out, we'll talk about the benefits of an IC disc, look at some ownership structure examples. Then I'll go into some more detail on the requirements and qualifications of the IC disc. We'll talk about the commission calculations, and then Chris will wrap up with the foreign derived intangible income incentive. So starting off with the IC disc stands for Interest Charge Domestic International Sales Corporation. It's a lot to say, so a lot of people refer to it simply as IC disc, or even just shorten it down to a disc from that. It's a tax savings tool that's available to exporters of US manufactured goods, but it's important to note that you'll commonly hear this referred to as a manufacturing export incentive, but the reality is it's not just for manufacturers. It can also be used by the agricultural industry, the mining industry, as well as distributors of products that are manufactured or grown or extracted in the US, and also people who provide architectural services or engineering services for construction projects outside the US. Those service providers could also qualify for an IC disc. So it's really not just manufacturers, but you'll hear the term manufacturer used a lot when talking about an IC disc. There are two types of an IC disc. All of our conversation today is going to revolve around the first type, which is the most common type. This is the commission disc, which is basically just a paper entity. It doesn't have any business substance. It really doesn't do anything other than it receives a commission based on the qualifying export receipts of the related supplier or manufacturer. We will talk about the commission a little bit later on. The second type is really not very commonly used, but it's referred to as a buy-sell disc. The main difference between a commission disc and a buy-sell disc is that the buy-sell disc will actually receive title to the property being exported, where the commission disc does not. The title to the property remains with the manufacturer. So why would we use an IC disc? The simple answer is it saves us tax. IC disc, the primary benefit is that you can get permanent tax savings. So we look at this two ways. Our operating company is either a pass-through entity, so either a partnership or an S-Corp, or it could be a C-Corp. If it's a pass-through entity, what we are able to do with an IC disc is we can shift ordinary income to qualified dividend income. And qualified dividend income is taxed at a reduced tax rate, the capital gains tax rate. So if we take an individual taxpayer who is able to benefit from the new Section 199 Cap A deduction, which is a 20% pass-through deduction, and let's say they are subject to the highest marginal rates, ordinary and capital gain tax rate, they would receive effectively a 5.8% tax savings on the commission amount of the IC disc. If we look at it from a C-Corp standpoint, C-Corps, the reduced rate from the new tax legislation, 21%, is pretty much on par with what an individual would pay as far as a capital gain tax rate. So you don't necessarily get the reduced tax rate in a C-Corp example, but you're able to get earnings out of the corporation where you avoid double taxation. And that could potentially create a 16% tax savings on the commission amount. So the primary benefit is the tax savings. A secondary benefit, which we'll talk briefly later on in the presentation, is that you can potentially defer income tax using an IC disc. Looking at examples of some ownership structures. So to kind of illustrate this, we have our operating company in the middle. And for this example, it's a pass-through entity. It's either an S-Corp or a partnership. So in this example of a pass-through entity, we would set up an IC disc as a subsidiary to the operating company. So our operating company pays a commission down to the IC disc and takes an expense, a deduction for tax purposes for that commission payment. The IC disc receives the payment, includes it as income, but as long as the IC disc meets all the qualifications under the federal tax code, it is considered a federal tax exempt entity, so it does not pay income tax on the commission it receives. It then distributes that commission back to its shareholder, the operating company, as a qualified dividend. So we kind of result in two things here. One, we have a circular cash payment. The cash at the end of the day goes through the IC disc back to the operating company, and it can be used by the operating company for its business needs. And second, we have taken that ordinary deduction at the operating company level and converted it to dividend income. So we have shifted income that would be taxed at an ordinary tax rate to income that would be taxed at a reduced capital gain tax rate. Adding some numbers to this example, let's assume we have taxable income of $100,000 in our pass-through entity, and we don't have an IC disc in our structure at this point. So this is the left column. So the shareholder or partner gets that 20% pass-through deduction. So our adjusted taxable income, $80,000. Assuming the highest tax rate, we would pay tax of $29,600 on that income. Now we add an IC disc to our structure. And for this example, we'll say our commission is $10,000. We'll talk a little bit more later on about how we can calculate that commission amount, but for now we'll just use 10,000. So now we have taxable income of 90,000 after taking our commission expense. Our pass-through deduction is now 18,000, so we have adjusted taxable income of 72,000. Again, using a 37% tax rate, tax is 26,640. Then down below, we have our commission income coming out as a dividend from the IC disc to a shareholder, $10,000 taxed at dividend tax rate. Assuming that the 3.8% net investment income tax applies and that we're in the highest capital gain tax bracket, that'd be 23.8%. So our dividend tax, $2,380. Our total tax, $29,020. So by adding the IC disc, we have saved $580 of tax in our scenario here, which is 5.8% of the $10,000 commission. So obviously, the more commission we can get, the more tax savings we can get. And that brings us to our first polling question. So our first question, have you previously considered implementing an IC disc structure in your business? All right, so we have, it looks like the majority have not considered, and we've had a few people who have considered implementing an IC disc. So we talked about the pass-through structure. So let's say our operating company is a C-Corp. So how would we implement an IC disc into a C-Corp operating company structure? Typically, we would use it as more of a brother-sister relationship because, as we mentioned, C-Corps don't have that reduced capital gain tax rate that you get at an individual level. So we set up the IC disc as a brother-sister relationship. Operating company pays the commission out to the IC disc. Again, it takes a deduction for that payment. IC disc does not have any income tax, assuming that it qualifies as an IC disc. It pays the dividend out to its shareholders. Shareholders pay tax at the capital gain tax rate on that dividend income. So we have effectively taken earnings out of our operating company where we have gotten a deduction. So we've avoided double taxation on that commission amount. Otherwise, if the IC disc wasn't in the structure, the operating company would distribute directly to its shareholders where it can't deduct that distribution. And then you have the double taxation problem that lies with C-Corps. One of the drawbacks of this structure is that based on this cash flow, the cash is now out to the shareholder rather than staying in the operating company like we had with the pass-through example. So if you do have a C-Corp and you want to have that cash back in the operating company, the shareholders would either have to loan it back to the company or recontribute it as capital back into the company. Let's look at some numbers with our C-Corp example. So again, assuming 100,000 of taxable income, 21% corporate tax rate. So our corporate tax is 21,000. That leaves us with 79,000 that we can distribute to our shareholder at a 23.8% tax rate, assuming net investment income tax. They would pay 18,802 on the dividends. So our total tax, $39,802, assuming no IC disc in our structure. Now we add the IC disc in. Again, we'll use 10,000 commission for the example. So our taxable income is now 90,000, which lowers our tax at the corporate level to 18,900. That leaves us now with 71,100 to distribute out to our shareholder from the corporation. The tax on that, 16,922. Then the IC disc distributes the $10,000 commission out to the shareholder. Tax on that, 2,380. So our total tax with the IC disc in the structure is 38,202, $1,600 less than if we didn't have the IC disc. So we've saved $1,600 by adding the IC disc to our structure, which is 16% of the commission amount of 10,000. So I talked about qualifying or assuming that we qualify as an IC disc. There's some rules that you have to comply with to meet that qualification. You have to be an eligible corporation. The IC disc has to be an eligible corporation. And the IC disc has to meet the what's called a qualifying export receipt requirement and a qualified asset requirement. And we'll go into some more detail on each of these items. So the first item, the eligible corporation. The IC disc you have to create a separate legal entity for to add an IC disc into your structure. And this separate entity has to be a C-Corp that's incorporated in any of the US states or District of Columbia. The corporation can only have one class of stock, and that stock has to have a minimum par or stated value of $2,500. And you have to maintain separate books and records for this new entity. And the last item, and probably the most important item, is that you have to file a timely election with the IRS to be treated as an IC disc. This is similar to making an S election. So you have to file Form 4876-A with the IRS to be treated as an IC disc, and this election is due 90 days or within 90 days after the date of incorporation. And that date is really important because if you miss that date, you can get late filing relief, but it's only possible through a private letter ruling, which is a costly endeavor. So if you're going to set up an IC disc, it's important to remember that 90-day rule to get the election into the IRS. And then once the IRS processes it, they will send you a letter saying they've accepted your election, much like you receive a S-Corp election acceptance letter. Because the IC disc is a separate legal entity as a corporation, it's required to file an annual tax return. It's filed on Form 1120-IC disc. And it's important to note that there is no retroactive benefit available for IC discs. So the benefit starts on the date of incorporation. So let's say, for example, today, November 21st, I create an IC disc. I can only use that IC disc from today going forward to the end of the year. So if I'm a calendar year taxpayer, any export sales I have from January 1st up till today won't count. So really the importance here is you want to get it set up as close to the beginning of your tax year as possible so that you can maximize the benefit in the initial year. The next requirement is the gross receipt requirement, which states that 95% of the gross receipts must be qualified export receipts. The first item here is really the one that most people use. And so you calculate a commission based on the sale, lease, or rental of qualified export property. And that commission is pretty much going to be the only income to the IC disc. And so if that's your only income, 100% of your gross receipts are qualified receipts, and you would meet this test. However, you have to make sure that you're calculating the commission on the sale of qualified export property. So that's a key term to remember, and that term is defined in the Treasury regs, and that there's 3 tests that you have to meet for property to be qualified export property. These tests are what's called the manufacturing test, the destination test, and the fair market value test. So the manufacturing test, simply stated, is that property must be manufactured, produced, grown, or extracted in the US by a person other than a disc. So you have your manufacturing company. What this means is you either have to, you can meet this by doing substantial transformation. So you take raw materials and you convert that into a finished good. The regs give examples such as you convert steel rods into bolts, or you convert wood pulp into paper. So there's some sort of conversion is going on. The second way you can meet the manufacturing test is that you're adding value to the property. So you take existing property and you have a 20% conversion cost that you add to that, either through labor or other materials that you add to that property. And so a lot of this is improving upon an existing product. Let's say, for example, you buy a plain t-shirt and you've got a t-shirt printing business and you add graphics to that t-shirt. As long as you meet the 20% conversion cost, you have been considered to add value to that property, and you would meet the manufacturing test with respect to adding the graphics to the t-shirt. And our second polling question, if a company has an IC disc in place, is it required to use it? Okay, so we've got 80% say no, 20% say yes. If you have an IC disc in place, you are not required to use it. So that's one of the good things about an IC disc is you can set it up in anticipation that you might benefit from it in the future. And because you don't get that retroactive benefit, sometimes it makes sense to set it up earlier so that you don't potentially lose out on benefit because you don't have it in place. But if you have an IC disc in place and you don't want to use it, or you aren't able to calculate a commission, you just simply file a 0 tax return and move on. So if you have one in place, you are not required to use it. So the next test for export property is the destination test. Destination test states that property has to be held for sale or direct use outside the US. And for IC disc purposes, the US includes all US territories. So this can be done in one of 2 ways. The first way, easiest way, is it's a direct sale. You ship the property directly to a foreign address. So you are the direct exporter of that property. The second item is the indirect method. So you are shipping to, say, a US address, but that property, even though you ship it to a US address, if that property is ultimately delivered or used outside the US within 1 year of your sale to the customer, then you could still qualify, you would still meet the destination test. So for example, say you sell to a US distributor, and that distributor then sells to a foreign customer and exports the property. As long as that's all done within 1 year of sale, you would meet this indirect export test. Or say you sell to a US customer and you deliver the property to the US address of the customer, but that customer is going to use the property outside the US, then it could potentially meet this indirect export definition and qualify under the destination test. However, the property cannot be used or further manufactured in the US prior to it being delivered outside the US. So in that example, you sell it to a US customer, deliver it to a US address, and they are going to use the property outside the US, but let's say they use it for a day in the US, and then they deliver it outside the US for use. Because they've used it in the US prior to its export, now you no longer meet the destination test. So if you are going through the indirect export route, it's careful to know what is going to happen to that property before it's exported, after it leaves your hands, but before it's exported. And there is a proof of compliance burden that lies with the seller. So in order to meet the destination test, the seller has to prove to the IRS that the property was exported and delivered outside the US. If you are unable to prove export, then technically you do not meet the destination test and the property does not qualify for the ICDIS benefit. There are a few items where the IRS deems property to be used in the US, therefore not qualifying under the destination test. Typically, this is if the property is re-imported into the US within 3 years of sale, or the exported property is incorporated into a second product as a component, and that second product is sold into the US within 3 years. Then technically the destination test is not met. Or if you have a reasonable person standard and you have reason to believe that the purchaser is going to use the property in the US, then it's deemed to be used in the US. Or there's an understanding at the time of sale that the customer is going to use the property in the US, or that it might be sold for use in the US, re-imported, then it wouldn't qualify. But as with anything in the tax code, there's always exceptions to the rules. And these exceptions are if you sell to a foreign retailer. So let's say you sell something across the border into Canada to a retailer, and it's quite possible that a US tourist goes into Canada, sees something, buys it, and brings it back into the US with them. But because you sold it to a foreign retailer, then it's deemed to have been used outside the US, even though it might make its way back into the US. And then for component parts, there's also an exception. So if, let's say you're making a valve that's going to be part of an appliance that's manufactured outside the US. So you make this valve in the US, you sell it to foreign manufacturer incorporates this valve into the appliance, and let's say that appliance might possibly be sold back into the US. The exception is if the component part is less than 20% of the second product's fair market value, then it has been deemed to have been used outside the US and you meet the destination test. The other exception is, let's say the second product is sold on a world market, then it's considered to, the component part of it is considered to have been used outside the US. But let's say, for example, that second product is sold specific to the US market, then you might not meet the destination test. The last item, we talked about the manufacturing and the destination test. The last one is a fair market value test. So no more than 50% of the fair market value of the property you're exporting can be attributed to imported materials. So fair market value of the export property is what you would sell it to an unrelated customer for. So let's say in our t-shirt example, that we bought t-shirts that were manufactured outside the US and we import them into the US so that we can add our graphics to them and then sell them. So let's say one shirt is valued at $5. So we import a shirt, our imported material is $5. We add our graphics to the shirt, and then we sell it to our customers for $20. So the imported materials of $5 as a percent of the fair market value of the export property, $20, is 25%. And because that is less than 50%, we meet the fair market value test. So we talked about the corporate requirements of an IC disc, the 95% gross receipt requirement of the IC disc. The last requirement to qualify as an IC disc is the qualified asset requirement, which says that 95% of the assets of the IC disc have to be qualified assets. And you can see on your screen here what qualified assets include. The asset that will typically be the largest asset on an IC disc balance sheet is that second item, a commission receivable. So when you calculate the commission, you accrue this receivable at the end of the year. That is the commission that the manufacturer is to pay to the IC disc. And that will, for the most part, be your largest and not only, but it'll definitely be your largest asset. The other asset will probably be cash. Cash is not a qualified asset. So it's important when you take your total assets that 95% of your assets have to be qualified. What this means is you cannot accumulate cash in an IC disc. But the big thing with the qualified asset requirement is that you only need to meet this test on the last day of the tax year. So for 364 days, you can fail this test and that's fine. But on the last day, on the 365th day, you need to meet this test, because if you don't, then you would disqualify the IC disc. All right, so we talked about commissions and we talked about how the tax savings is really generated through the commission. So how do we determine what that commission amount is? This is really where the bulk of the time is spent with an IC disc, is in determining this commission, because we want to maximize the commission, because doing that maximizes our tax savings. So the Treasury regs list some acceptable methods to calculating the commission. One of which is you can take 50% of what's called your combined taxable income. This is like your net export income, and it's abbreviated CTI. The second method, you can take 4% of your gross receipts. So you sell property for $100 for export, you would take 4% of that gross receipt, and that would be your commission. The last item is you can do a marginal costing calculation to determine the commission. There is what's called a no loss rule with the commission, which means that your commission cannot exceed your combined taxable income. But again, tax code loves to have exceptions to rules, and so there's an exception that says under the marginal costing method, you could potentially get a commission even though your combined taxable income is below zero. Combined taxable income, as I mentioned, is your net export income. So you calculate it by starting with your qualified export receipts. You subtract out of that the related cost of sales to that sale, and then you subtract out of that an allocation of SG&A costs. And this could be costs that are specifically related to exporting, or a ratable allocation of costs that are not specific to either export sales or domestic sales. The result of that is your combined taxable income. So your sale less your cost of sale less SG&A costs. The commission by default is calculated on a transaction by transaction basis. So you take each of your transactions independent of one another, and you calculate a commission on each one of those transactions. And that method actually allows you to maximize the commission. You do have the ability to group transactions by products or product lines. So you would calculate the commission on a product basis versus on a transaction by transaction basis. If you do the grouping, it will apply to all transactions within that product, but all transactions that are not included in the group product would remain on the transaction by transaction basis unless you make another product grouping for those remaining transactions. The marginal costing method is basically an alternative way to calculate your combined taxable income. So your marginal costing combined taxable income is the lesser of either your marginal profit, which is your gross receipts less cost of goods sold, or your gross receipts multiplied by what's called an overall profit percentage, or OPP. The OPP is generally your taxable income of the related supplier divided by the gross receipts. And then your commission would be 50% of that marginal costing CTI. So let's go through some simplified examples of calculating the commission and putting some numbers to what we just talked about. So we have 4 transactions here. Let's look at the first transaction. We have a sale, an export sale of $1,000. Our cost of goods sold on this is $200. Our allocated SG&A cost is $500. So we have combined taxable income on this transaction of $300. So if we go to the bottom, we can calculate our commission using each of the methods that we discussed. So the 50% method is 50% of combined taxable income. So that's our $300 multiplied by 50%. So that commission is $150. The 4% method, we take 4% of our gross receipts. $1,000 multiplied by 4% gives us a commission of $40. The marginal costing method, we take the lesser of our gross margin, which is $800, the $1,000 less the $200 cost of sale, or our OPP profit, which is our gross receipts, and we're going to assume our overall profit percentage here is 10%. So our OPP profit is $100. So we take the lesser of 800 and 100, so that's $100, multiply that by 50%. So we have a $50 commission under the marginal costing method. So our best method here is the 50% of what we call regular costing CTI, which is $150. Going over to transaction 2. Transaction 2, our combined taxable income is $50. So we go through each of the methods again. 50% method, we get a $25 commission. 50% multiplied by $50. 4% method, again, $40. Marginal costing, however, now has dropped down to $35. The reason it dropped down to $35 is because our gross profit is $70, and that's less than our OPP profit. So we have to take 50% of our gross profit to get to the $35. So in this example, the $40 under the 4% method gives us the best result, and that's the commission we can take for transaction 2. Moving to transaction 3, we have $80 of CTI here. So our 50% method gives us a $40 commission, also 40 under the 4% method. But now our marginal costing commission is $50, which is 50% of the $100 OPP profit, because our OPP profit is less than our gross profit. So that gives us the best result. So $50 is the commission for transaction number 3. Now moving to the last transaction. This one, you'll note our CTI is negative. And under that no loss rule, we cannot take a commission if we do not have positive combined taxable income. So we are unable to take a commission under the 50% method or the 4% method. But remember, there's the exceptions to that. So we have our marginal costing exception. Under marginal costing, we have combined taxable income of $50, which is our gross profit. So we can take a $25 commission under marginal costing. But now, because we have negative CTI, that's where that special 4% method comes into play. The special 4% method says that we can take a commission of 4% of our gross receipts as long as that commission is less than our OPP profit. So $40 is less than our OPP profit of $100, so we can take a $40 commission on this transaction. So we add that all up, and our total commission on a transaction by transaction basis is $280. Now compare that to the far right column. This column, we have combined all the transactions together. And under a combined grouping, our commission would only be $200. So by calculating our commission on a transaction by transaction basis, we have increased our commission by 40% from what it would have been if all the transactions were combined together. So that shows the power of being able to really maximize the commission by calculating it on a per transaction basis. Our third polling question, let's say we have a US manufacturer that sells property to an unrelated US distributor on July 1st. The distributor then resells the property as is to a foreign customer and exports that property on September 1st. So can both the manufacturer and distributor benefit from an IC disc on the sales? So we have 43% yes, 57% no. So the answer on this one is yes. The key is the distributor sold the property on an as-is basis. So that leads us to believe that it was not used or further manufactured by the distributor in the US. And second, the second sale took place within 1 year of the first sale. So for A, they still meet the manufacturing and destination test. B also meets all those tests because they are selling property that was manufactured in the US and they are selling it for export outside the US. And we'll make the assumption that the fair market value test was met. So both parties could benefit from an IC disc on the sale. A few things to note on the IC disc commission. The commission has to be calculated based on taxable income figures. And an estimated commission is required to be paid into the IC disc within 60 days after the end of the year. So let's say we have a calendar year 2019 taxpayer. We have to pay an estimated commission into our IC disc within 60 days after the end of this year. So that's roughly the end of February 2020. The reg says there's a safe harbor rule that says as long as you pay in 50% of the actual commission, they'll consider that to be a reasonable estimate. But most of the time, taxpayers don't know what their taxable income will be by the end of February or 60 days after their tax year ends. So because of that, there's most likely going to be a true-up commission. So we have our estimated amount within 60 days, and then let's say in the summertime, we get our tax return, we know our taxable income, and now we know our actual commission. So we have 90 days from the date we determine the actual commission to make any true-up payment into the IC disc. And the payment deadlines are important because if they are not met, what happens is that the commission receivable that we accrue at the end of the year is now not considered a qualified asset. And as I mentioned, that's typically the largest asset on your balance sheet. So if that is not a qualified asset for IC disc purposes, now we do not meet the 95% qualified asset test, and we will disqualify the disc. There is relief if this does happen. There is relief available. It's more procedural type issues, so it's not really the end of the world, but the key is to make sure you get those payments in on time and to potentially avoid disqualifying the disc. I mentioned tax deferral early on. So the IC disc does allow a tax deferral as a benefit. There is no requirement that you have to distribute accumulated earnings out of the IC disc, but there are some limitations. So As I mentioned, first, the qualified asset test has to be met on the last day of the tax year. So you have to consider what is your cash in the IC disc and do you meet that 95% qualified asset test? Second, the deferral is limited to commissions that are related to the first $10 million of qualified export sales. So you can defer the first $10 million of qualified export sales, the commission related to that. Any excess sales, or if you have export sales in excess of $10 million, the commission related to those excess sales falls under what's called a deemed dividend. And there's also some other items that can cause a deemed dividend. And what a deemed dividend is that this deemed dividend amount is considered tax to the shareholder in the current year, regardless of whether an actual distribution is made. So you need to consider the deemed dividend amounts in the tax planning with an IC disc, but you still get the benefit. It's still dividend income, taxed at a qualified capital gain tax rate. You just can't defer that. So to meet the qualified asset test, really what needs to happen is when you pay that cash into the IC disc for the commission amount, is you have to convert that cash into a qualifying asset. And doing this requires some careful planning so that you don't inadvertently disqualify the disc. So we really won't go into a whole lot of detail on that, but just note that really what you have to do is you have to convert cash into a qualifying asset to benefit from the tax deferral. And if you do defer tax, there is an interest charge that applies. That's the IC and IC disc. And what you do is you take your deferred tax amount multiplied by the interest rate. The interest rate is published typically late in the year by the IRS, and that gives you what your interest charge will be. And the interest is based on typically the current T-bill rate. So with the drop in interest rates recently, that interest rate is probably falling. I think for 2018, it was roughly about 2%. Then the last item I want to mention is state tax considerations. So IC disc is a federal tax incentive under the Internal Revenue Code. But not all states follow federal treatment for the IC disc, and they might treat the IC disc as a normal corporation, meaning they don't treat it as a tax-exempt corporation like the federal government does. So what that means is the states might tax the IC disc, and you might have to pay state income tax at the IC disc level, or some states might disallow the commission deduction. So for state tax purposes, you don't get that commission expense on the manufacturer's tax return. So a lot of states don't even really address IC disc, but it's important to note that when setting this up, you need to look at the state that you're doing business in and look at how that state would potentially treat the IC disc. And with that, I will hand it over to Chris, and Chris will go into some detail on the foreign-derived intangible income benefit.
Thanks, Mark. I appreciate it. We've got just a few minutes here to cover what arguably could be a lengthier topic, but really the point of discussing the foreign-derived intangible income benefit or deduction at this point is just to give you a high-level overview of something that's new, out there that came out of the tax reform over the last couple of years and is now eligible for certain taxpayers to help them with some of their, let's just call it export sales, for lack of a better word. So we'll quickly go over this. Mark, just for your benefit, I do see a question in the queue, so I'll try and leave a couple minutes to get a response to that question. Here's the big picture. The foreign-derived intangible income, FDII, or FDII for short, is how it's being tossed around out there in the tax community. So this is under new section 250 of the Internal Revenue Code. As we can read here, this creates this preferential tax rate for income derived by basically domestic corporations who are serving foreign markets, and we'll go into that just a little bit briefly. It creates this preferential rate through offering a deduction of against your taxable income which obviously reduces your taxable income. Effectively, it works out that this corporation will pay what is an effective rate of 13 1/8 versus 21% on its income that's being derived in foreign markets. So for sales and income being derived outside the U.S. It is really only available to C corporations at this point for the deduction. Statutorily, that's the way that Congress put this into place. As a brief overview of what this is, as we mentioned, it allows a domestic corporation to make a deduction. The amount of the deduction is 37.5% of what is a calculated foreign derived intangible income, FDII. It also does allow under Section 250 an additional 50% of something called GILTI that is included in its gross income. That is a little beyond the scope of our discussion today, a discussion around GILTI, but know that that's the stick portion of international tax reform, whereas FDII is the bit of the carrot and more the incentive. It's important to note that this deduction can also be reduced when the amount of FDII and GILTI exceed taxable income. This has come up in a few instances where it looks like we're going to eliminate our taxable income as a benefit for FDII, and it turns out not so much because the benefit exceeded our taxable income. As we can see here, deductions are only available to domestic C corporations who are not RICs or REITs. The allowable deduction percentage does decrease in future years down to 21 7/8 beginning after December 31st, 2025. So it's temporarily set at 37.5. So taking advantage of it now would be beneficial. Mark wanted to slip in one more polling question to make sure everybody was paying attention during his IC disc discussion. New polling question: U.S. manufacturer A sells property to U.S. person B. B further manufactures the property and exports the property. Does the sale by A count as qualified export property? This will be your last polling question. Mark, I'll let you decipher the answers here. We've got 39% saying yes, 61% saying no.
Sure. So in this question, does the sale by A count as qualified export property? The answer is no. And this is because B further manufactured the property before they exported the property.
All right. Thank you for that. Hope everybody noted that distinction there. Thanks, Mark. So to calculate this Section 250 deduction, it's a multi-step process. You can see step one, you calculate what is called your deduction eligible income. That is effectively your overall U.S. taxable income for your U.S. C corporation. Step two, you need to calculate the foreign portion of that deduction eligible income, and this is where things can get a little bit more nuanced within the calculation. You've got to determine what your foreign sales were. Then you also have to allocate and apportion deductions that would be, I guess, allocated towards those foreign sales as they would kind of in an IC disc to come up with what would effectively be your net taxable income on foreign source income. Step three, you need to calculate something called your deemed intangible income. This is essentially your net fixed assets or business assets times 10%. When they put this in place, they determined that a 10% return on your fixed assets was a threshold that would needed to be passed in order for you to take advantage of the deduction. Last step is to calculate FDII or FDII after you've come up with some of those numbers. As a quick example of how some of these numbers work, just pay attention to the left column. At this point right now, we can see without the FDII reduction, the deduction eligible income, so our overall taxable income would be, let's just call it $2 million. The foreign derived portion we're saying is $500,000, so that again would be the effectively net income portion of the foreign derived portion. So 25% of overall deduction eligible income is foreign. We can see our qualified business assets. So that would be our net fixed assets. That would be gross minus my accumulated depreciation is a nice round number for this example of 1.5 million. We can see that the deemed tangible income return is that 10% of the 1.5, so 150,000. That gives us deduction. That gives us a deemed intangible income of 2 million less the 150,000 to give us 1.85 million. That deemed intangible income, we've got to figure out how much of that is foreign. Unless we apply that foreign derived portion of deduction eligible income ratio to deduction eligible income of 25%, gives us the foreign derived intangible income, or FDII, the number we're looking for, of $462,500. You can see here that in this example, we decided that net taxable income would end up being $2 million. So we do not have a FDII or a FDII reduction. We take the deduction percentage of 37.5% times our $462,000 FDII amount to give us a deduction of $173,438. So it's very mechanical once you get into it. There's some nuances behind some of these definitions that we're going to gloss over a little bit today, but we'll if you need to let us know. We can obviously dig in and assess some of these nuances. I just wanted to throw in there this FDII reduction that happens in there. Let's just say you've got your deduction eligible income of 2 million, but for whatever reason you had NOLs that you're applying. You reduced your net taxable income down to $200,000. You can see now that the foreign derived intangible income exceeds that $200,000 by $262,000. Thereby, we have to reduce our FDII amount by $262,000 and then apply the deduction percentage, reducing our eligible deduction down to $75,000. Really, I just want to illustrate that this FDII deduction is not going to drive you down to zero taxable income. It's just a general benefit overall. One thing I wanted to just address in the last couple minutes that we have here, part of that step 2 where you calculate the foreign portion of the deduction eligible income, what you do is you need to look at your foreign derived sales, basically. And sales is a little bit broader than what it means for an IC disc. It's not something that needs to be manufactured in the US. It's just a sale that's been made for ultimate foreign use. And there's a little bit of paperwork that you need to keep to help determine what is ultimate foreign use or prove that it was used for foreign use. Sale is also broadly defined as any lease, license, exchange, or any other disposition. You can also sell, in this instance, services are eligible towards this deduction. So there are a few broad items here for FDII to consider, and just something you might want to be taking a look at if you're a C-Corp and you do have some foreign sales out there. That being said, we'll open it up for 2 minutes of questions, or if you wanted to hang on longer, I'm sure we could go a little bit longer. Mark, as I mentioned, there is a question in the queue out there.
Yeah, so I see the question. So there's a question talking about the qualifying asset test and the distribution of cash. So would you need to distribute cash to the extent of the par value stock to maintain the 95% asset test? So basically what you would do is you would take your assets at the end of the year, multiply the total assets by 95%, and then hope that or plan that more than 95% of your total assets fall under the qualified asset requirement. So in general, what companies will do is, let's say you have, in our example, we had a $10,000 commission. So you would pay that $10,000 commission in to the disc, and then you would distribute $10,000 out. And let's say we have $2,500 par value stock in the disc. Then at the end of the year, our cash would just be the $2,500. So one thing I forgot to mention earlier is that the IC disc is required to have a bank account because these cash transactions do have to take place. So the recommendation is to set up the bank account and contribute the stock contribution within the 90-day election period requirement, and then always maintain that minimum cash. So the $2,500 stock would be considered for more or less working capital, and you would just maintain the $2,500 cash in there at all time, and then you would just cash in is the commission, cash out as a distribution. So hopefully that all makes sense.
All right, if you do have any questions, you can use the Q&A box or the chat feature. You can also reach out directly to our presenters if you would like. Here's their contact information. All right, I don't see any questions coming through, so I hope everyone has a great day, and thank you to our presenters, and we will talk to you next time.